was the first snapshot of first quarter GDP, and it missed the mark. The U.S. economy growing at a slower than expected 2.5% in the first quarter versus hopes for a 3% gain. Our next guest says the U.S. continues to be the, quote, best of the worst, and that our economy and our markets face a difficult road ahead. Jim Frischling, NewOak Capital president, joins me now. You know, you're saying that the government spending cuts, not only a factor in the first quarter number we got today, but you're saying going forward we're going to have to really be concerned about cuts.
No, I think that's right. When you have higher taxes and the government pulling back on spending, you're going to see both those hit GDP. And I actually think while the number itself certainly was far better than Q4, let's remember we had a measly 0.4% at the end of 2012. So 2.5 certainly showed some signs of growth, but missed expectations. It was driven by the consumer. That's the good news. It was driven by businesses restocking some inventory shelves. The bad news is, again, government not spending, imports up, both hit GDP.
You know, Nicole was talking about Pfizer being one of the big movers today on the markets. I know that you're getting a bit defensive. I know that healthcare is one of the groups that you're using as a defensive play for your clients.
Yeah, I mean, we are thinking that the market is clearly being driven more than anything else by the Fed. And to a certain extent, some of these, I guess, missed expectations and numbers and whatnot certainly arm the Fed with the ammunition to stay the course. But we are looking at utilities, we are looking at healthcare, and we're looking at the more defensive stocks. We think you got to be invested in stocks, but you're going to have to choose the more defensive ones.
All right, so stay on the defensive side. Also, you know, you mentioned the Fed. They're going to be meeting next week. I mean, you're under the impression, as most are at this point, that they're going to leave that $85 billion buying program in place.
Yeah, I think they're gaining momentum to, or rather, have more ammunition to stay the course. I think the concerns about a spring swoon for a third year in a row, and a weakening economy, I don't think the consumer is going to be as strong for the next couple of quarters, in which case the Fed is going to be armed with the information they need to really stay the course.
What do you mean when you say that this country is the best of the worst right now?
I guess that's a little extreme, but I do see
funny.
I do see a slowdown in China, and you just still see Europe while they're digging themselves out. You see what's going on in their area, and to a certain extent, the U.S. among the major places, I think, has taken certain measures to put itself in the best position relative to its competition. So the U.S. Central Bank, the Fed made the moves first. I think Europe is still struggling with tremendous unemployment, and look, China at 7.7% growth is still enviable, but far below their 10% threshold. So we think the China slowdown will hopefully cheapen some commodity prices, and we think ultimately the U.S. is better insulated from the actions in Europe and China. So the best of the worst really meant better than Europe and better than China.
Well, never mind. Somebody said something funny. I'm not going to repeat it on live TV, but it was kind of along the same lines. I had another analyst say that to me off camera a few days ago. Let's talk about earnings, because, you know, Nicole was mentioning all these big names, but it's a huge week for earnings. Dow's been up for the last 5 sessions, so we're looking good, but you're concerned about revisions that you're seeing.
Yeah, the number of companies that now are revising downward versus the number of companies that are adjusting upwards, I think, is a multi-year imbalance. And to a certain extent, there's a lot of gamesmanship going on. We certainly feel that the low interest rate environment is allowing companies to borrow and to do more with less. But I will tell you that in a downward environment where earnings continue to be, I guess, where expectations are being lowered, hard for the markets to rally when you're seeing the companies coming out and trying to downplay their own earnings, whether it's revenues or the net income they're generating.
But yet we've been up for the 5 last sessions. So.
And again, I think when I look at the market, I see, and we should never misunderstand Wall Street from, let's say, Main Street. And I do think the stock market is getting a big benefit, again, from the low interest rate environment and the stimulus program, whereas I think Main Street is still kind of slushing along. So again, I do think, given the risk premiums that are available in stocks, it is still the best place to put your money. Just do it selectively.
You mentioned, you know, consumer staples. I mean, that's one of the traditional defensive sectors. But, you know, we were looking at consumer sentiment that came out today, and it was actually down over the last month. So if the consumer is losing a little bit of confidence, you got to wonder about, you know, how far these sectors can go if we do see spending pull back. I mean, it's kind of a question mark.
The consumer spent a little more money when gas prices got expensive, and I think now that gas prices have come off a little bit, I think there is the opportunity to, let's say, have a little more disposable income for other things. But I think the GDP report was driven a lot by the consumer. I think the best spending they've done in over 2 years. We don't think that itself can continue. We do like the housing market has been the great bright spot for the last 8 quarters, and even I think new construction spending was once again up over 12%, 18% the previous quarter, 14% the one before that. So housing, I think, continues to allow the consumer to feel better about things. Income somewhat weaker, paying more taxes, their house is worth more, and they're looking at their portfolio and they have seen an uptick. So there's a lot of balancing acts.
I have to say, and Jim, it's always great to talk to you. I have to say, though, it's interesting. You know, what we're seeing is like back in '92 when you saw that it was cheaper to own than to rent.
Yes.
We're in that right now in this country, and I think that this might be an interesting turning point for the economy. I don't know about.
And again, I think the mortgage business for the banks is really significant, and you're going to see more loans being made. There are more high-quality loans, but expect mortgage financiers to deploy capital.
Oh, all right. So much covered in a short amount of time. Jim Frischling, thank you, Jim.
Nice
Good
to
see
be here.
you.
Thank you.